Good afternoon, everyone, and welcome to our second quarter webinar event. We're just over midway through the year, and we know it's been a difficult start to 2022. Inflation, rising interest rates, they've posed challenges. The US stock market is in its first bear market since the pandemic, but even more presciently, is it the first real sustained sell-off we've seen since the global financial crisis. We're going to dive into all of these topics and more as we share our views and then what we're doing about it in your portfolio. And for today's discussion, I'm Gerald Guger, Head of Content Strategy at Manning & Napier, focused on bringing you the unique views and perspectives of our firm. And I'm excited to be joined here today by Susan Pilon. Susan is a financial consultant in our wealth management group and a recent addition to our firm in the Tampa-St. Pete region. She brings a length of experience in the financial services industry, providing planning strategies and investment solutions across the full array of client needs. Susan, welcome.
Thank you, Jerry. Glad to be here.
Awesome. And I am also joined here today by Chris Petrosino. Chris is the director of our investment policy group, responsible for setting the firm overview on our broad macroeconomic outlook globally, as well as on global financial markets, both equities and fixed income, at home and abroad, as well as on asset allocation decision-making. In addition, he is the managing director of the Quantitative Strategies Group, focused on managing our ETF-based solutions, as well as our disciplined value suite of solutions that focus on the importance of quality and yield. Chris, welcome.
Thank you. It's great to be here.
And our agenda today is as follows. First, we're going to start with a discussion of the state of the economy. We received a number of questions on whether we are in a recession today or if it's on the horizon, on inflation, on the sell-off, and where we think it's all going to go from here. So we're going to address as many of those as we can right at the beginning. Once we finish sharing our economic and market perspectives, we'll discuss how we are putting those views into action within your solution, both from an investing standpoint, what we're doing in portfolios, but also from a planning standpoint as well. And then after that, we've got a new section this quarter that we're calling Rays of Sunshine. It was Susan's idea, perhaps due to the climate, and all credit must go to her. Although, as I said, I'm not really seeing any rays of sunshine this morning in Rochester. But either way, in that section, we're going to share 3 different insights that we think may give everyone a sense of perspective and calm. We know there's a lot of consternation about the state of the economy, about the state of financial markets, and we're looking forward to sharing some of those views. And lastly, we'll leave the end open for live Q&A and answer a number of pre-submitted questions that we received ahead of time as well. And we appreciate you all for doing that. As a reminder, we encourage you to submit any questions you have throughout today's event by clicking on the Q&A box on your screen. And so with that, Susan, I'd like to turn it over to you to set the theme for today's event. Susan?
Absolutely. Thanks, Jerry. I love this quote on the screen from John Templeton. The 4 most dangerous words in investing are, "This time it's different." And I love this quote because I've been in the financial services industry for 25 years, over 25 years actually, and at different times throughout my time here, I have had people say to me, "Susan, it's different this time," so many times. And you know what? They're not wrong, because at these different times with different fact sets, different events happening, there are things that are slightly different, right? We all just went through a global pandemic that most of us weren't alive to see the last one of this magnitude. We've seen bubbles with the, tech in 2001, with real estate. We've seen economic conditions with really high interest rates and really low interest rates. And we've seen inflation recently that we haven't seen in quite some time, and political environments that have been different. And, there's information coming at us all the time today. And all those are different, but at the same time, oftentimes when we look back at these events, they can rhyme quite a lot. What isn't different is the investing principles. When I was a little girl, when most kids were being read bedtime stories, my dad was telling me, sitting down with me with the interest rate wheel, talking about the power of compounding. And he would sit there and he would say, Susan, if you can save this much and get this kind of rate of return, here's how much money you can have someday. And I did get read bedtime stories as well. But that being said, I think I was very fortunate to learn those investing principles early on, because while there is always bad news of the day, and sometimes it is truly bad news, and sometimes it's noise, but where there's always bad news of the day, the danger is in thinking it's going to impact investing differently over the long term, and thinking that that bad news is going to relate to bad investment outcomes. We've been through it before, and I have faith and confidence that we will get through it again.
I love that distinction that you drew between timeless principles, but the fact that markets do evolve and they change over time. The other word that jumps out, of course, is dangerous. And one of the most dangerous things investors can do is lose perspective. So, Susan, perhaps let's kick off the market and economic part of the proceedings by talking about having a longer term perspective.
Absolutely. So on this next slide, we're going to see that perspective is so important. If we look at this chart, and this goes back to 2005 through 2022, and this is going to show us a full market cycle. But if we shortened that view and looked at just days, that volatility would amplify, right, very quickly. So what we can see here is how far that we have come. And I just want to think about, though, even a shorter time, but still giving us some perspective. So if we had an investor that fell asleep in 2018, at the end of 2018, and they fell into this deep sleep, think Rip Van Winkle, right? And they go to sleep and they wake up yesterday and they go, what's going on in the world? And they find out we had a global pandemic, and they find out there's been war, and they find out that there's been, all this inflation of late, and they go, oh my gosh, I better go check the market. I better check my portfolio. And they look at it and they go, phew, wow, this is actually good based on all I've just heard over the past couple of years. And my portfolio is good. I'm actually up. And then they talk to their friends and family, and their friends and family are talking about all that they've lost recently. And this year has been tough. But we know that we kind of anchor to that high number, and our latest high number is the one that we look at. But if we went back a couple of years, that high number anchor would have been a little bit lower. So it's keeping that perspective and knowing that long-term view is going to help us. And you know what? Down the road, we're going to look at this time frame as an example too. We just don't know when yet.
It's amazing, anchoring bias and really all of those various behavioral finance biases, they can make a huge impact longer term. So thinking in terms of trying to keep that, clarity of thought and not being succumbed to various biases, Chris, one of the key differences that we are seeing during this particular market cycle, and the next visual really calls it into incredible attention, is inflation.
Absolutely. So fueling this iteration of the "it's different this time" narrative certainly has been inflation. And here we've charted out the year-over-year change in the core consumer price index, which is basically the basket of goods that folks consume, stripping out energy and food, which represents some of the more volatile components. And while certainly those are very real consumption items for all of us, this gives us a sense of what's going on under the surface. And really, for the past 20 years, we've enjoyed a very benign inflation environment, more often than not somewhere around the 2% neighborhood, plus or minus a tiny bit. But after the world reopened following the onset of the pandemic in early 2020, we've been thrust into a very different regime here. Basically, core CPI, the rate effectively tripling from what we've enjoyed over the past 2 decades. And if we look at headline, which includes those very, very real, very important items, including energy and food, our most recent growth year over year was 9%. So clearly, these are jarring, especially to what has been our collective experience now for some time. But if we step back and we talk about perspective again and zoom out a little further, and instead of looking at 20 years, go to 50 years, it's clear that while this has not occurred in a very long time, it is also not without precedent in terms of having elevated peacetime inflation here in the U.S. And certainly not to, this is not meant to minimize what is going on today, nor make a projection that we are on schedule for a replay of the 70s and 80s, but rather just to make the point that there are historical periods that we can draw lessons from, we can learn from, and look for how that may rhyme today and help inform decisions that are being made both at the policymaker level that we'll talk about in a second, but also within portfolios. And it's also worth pointing out that this time frame that we're looking at is also the collective history of Manning & Napier as an investment firm. And while certainly the folks that were making those investment decisions on client behalf in the 70s in those high inflation environments are not making those decisions today, the lessons learned have been memorialized in our investment processes, in our investment strategy manuals. So there are, we do have the ability as a firm to draw back on some of those lessons that even we learned over this window. So I had mentioned policymakers, and one of the narratives now has certainly been that the Fed is asleep at the switch, or had allowed the economy to run far too hot before embarking on a rate hike cycle. And the exhibit that we have here speaks to that. We looked at rate hike cycle start dates, so the first time that the Fed was increasing the discount rate after a period of cuts, and looked at where was CPI growth, where was unemployment, where were hourly wage growth. And basically what we see here is, in March of 22, when this cycle began, we had a CPI inflation that was running relatively hot by historical standards, unemployment historically low, so a very, very strong, very, very healthy labor market, and similarly wage growth running towards the upper end of the spectrum of prior rate hikes. Of course, it's important to think about the context in which the Fed has been operating in, which was an economy that fell into recession basically overnight as the world shut down, as the pandemic unfolded. And there was a lot of uncertainty as things reopened as far as how much of the inflation that was out there was more of a supply chain issue, sort of the ill-fated transitory description that the Fed had used in numerous messages, and how much of it was a bit more long-lasting. But on the positive side, I think once it became clear that this wasn't just a function of supply chains or workers choosing to stay home because of extraordinarily generous unemployment benefits, once it was something more sticky, the Fed has jumped into action in a big way. And we most recently saw with yesterday's meeting another 0.75% or 75 basis points, as we say, rate hike, bringing the top end of the Fed funds rate now to 2.5%. When you consider just 6 months ago, it was 0.25%. So significant increase in less than 6 months. And put some frame of reference on it, the Fed made that same degree of increase back after the expansion started following the financial crisis, but it took them 3 years to get there. So we did, what was last time took 3 years of monetary tightening in just 6 months. So clearly, they have responded aggressively, and we can also see that in interest rates if we look out beyond just the Fed funds rate. And so here we've got two different benchmark rates for you: the interest rates on the 10-year Treasury bond in the light blue or teal, and then the 2-year rates in the dark blue. And certainly to start the year, we saw the yields on the longer maturity bonds, 10 years and out, really back up quickly. And that was in response to those concerns of inflation. But more recently, we've seen the shorter maturity bonds move up similarly. And so here we actually have, if we were to update this data through today, we have the yields on 2-year Treasury bonds actually above those of 10-year bonds. And that's what we refer to as an inversion, an inverted yield curve. And historically, that can be a very powerful sign of slower economic growth and recessions ahead. Is basically it's telling us that the bond market expects growth in the future, which influences the price of future money to be lower than it is today. And generally lower growth also entails lower inflation.
And it certainly has an implication in portfolios too, right? For our existing bondholders, as those yields are going up, the price of the bonds are going down. So it's a drag on performance. That being said, it's also nice to be able to earn some more money. And as those credit spreads widen, we're going to be able to find some more yield. So there's some positives in that, some rays of sunshine there a little early. But Chris, that's what the bond market's kind of telling us and where it's at. What are stocks telling us?
Absolutely. So given the backup in rates that we've experienced year to date, the market's concern with inflation, with the Fed embarking on a rate hike cycle, the market certainly has begun to react and react in a very meaningful way, with the S&P 500, for example, down about 20% from its peak. But that was largely, I believe, a function of correcting some of the excesses in valuation. Right, we came through a period of incredible monetary stimulus, incredible fiscal stimulus, in an environment where there was lots of tailwinds for equities, for the markets broadly, and that really pushed valuations to a high level. So, for example, at the start of the year, the price to earnings ratio based on next 12-month earnings expectations for the S&P 500 stood at 22 times. Today, we're closer to about 16 times next 12-month expectations. So good news there. But the risk that we see from this point is those valuations are based on earnings expectations that are still quite robust. And so if we look at the charts here and focus on the lower panel, this is the sort of collective consensus Wall Street estimates for the next 12 months earnings per share for the S&P 500. And what we can see is they continue to project the growth. We have not yet seen a wholesale marking down of earnings expectations. And so while 16 times earnings is a historically reasonable number, the challenge is you have to start questioning, well, are those earnings actually going to come through? And the top panel just represents what happened to those same consensus earnings as we went through the prior recession in 2008 and 9, and there eventually there was a reckoning as those earning expectations came lower. So that is something that we've not yet seen. And so while certainly the volatility and downturn that we've experienced to date has been meaningful, we're still waiting for some additional signals from the market before we would start to increase equity exposure and risk in a meaningful way in our portfolios.
Chris, if I could jump into one thing that jumps out to me in that top chart, the market, I believe, as a point of reference, bottomed March 9, 2009, if memory serves me right. And, 2008 was certainly not a year of, extraordinary market returns by any stretch. And then to have bottomed then, it's funny how coincidental it is with when earnings eventually reached their low.
No, absolutely. Generally, markets tend to bottom when pessimism and fear is at its worst, and expectations collectively are that the sun's not coming up the next day. And while, again, we've lived through a meaningful downturn so far, expectations still are not exceedingly pessimistic.
So if I could then put kind of the pieces together a little bit, we have certainly cautious views on expectations within the equity market, and there are certainly concerns within the bond market as well, as yields have risen and the challenges that that's posed. And our economic outlook remains cautious, to say the least. So in this next section, if we could put those pieces together, we know that we see all of those anxieties out there. What actually can we do about that, and are we doing about that for clients in their portfolios and really in their overall solution. And so to kick off the answer to that not insignificant question, I do want to send it over to you, Susan, first to give us another quote.
Thanks, Jerry. Another great quote here, this one from Warren Buffett: "The stock market is a device for transferring money from the inpatient to the patient." And as investors, again, we've talked about this behavioral finance a little bit, but our behavior dictates so much of our success. And we're going to talk about that a bit more later, but it also helps us if we can be patient. It's also why we can get the returns that we get from the market, because certainty yields a lot less for us. So sometimes inaction is the answer and is what really is good for us and can get us to where we want to go. And we leave that active management to our experts, to Chris and his team, to be looking at all of those data points and figuring out when that action piece is right. So Chris, will you share with us where we've been and where we're going?
Absolutely. So I think a good frame of reference is to look at the stock exposure within our balanced, our multi-asset class portfolios. And so for reference here, we have plotted the stock allocation of our long-term growth portfolios going back to 2017. This is a investment objective that has a midpoint policy allocation to equities of 55%. And of course, us as active managers have considerable flexibility to deviate from that midpoint based on the opportunities that we're seeing at the individual company level, as well as the overall macroeconomic and market backdrop. So if we just focus on the last 6 or so bars on that, on the chart, starting with peak equity positioning for this cycle in mid 2021, this was a period where we were still reaping the benefits of incredibly accommodative monetary policy, of very generous fiscal policy in companies still recovering from the pandemic. And so the backdrop was positive. But as 21 and 22 unfolded, we saw that backdrop becoming less favorable. And at the individual company level, as valuations continued to go higher and higher, the risk-reward equation became less favorable. And so a natural outcome of that was to start reducing equities, selling individual positions, or just trimming around the edges as the risk-reward calculus became less attractive. And so between the middle of 21 and the midway mark here in 2022, we've seen over a 10% reduction in equity within our portfolios, actually closer to almost 15%. And this brings us to a point today where we're starting to get some questions in terms of, hey, when the pandemic unfolded and the market dropped a big chunk, we were very, very quick to act. And what are our expectations at this point? And while certainly 20% is a meaningful decline, we're also not yet in an environment where we have those tailwinds. We have those tailwinds of extreme pessimism, those tailwinds of accommodative policy. As just covered, we just are fresh off of another significant rate hike and expectations for more rate hikes. So the conditions aren't there. So instead, what we're working on is looking at the investments that we own and the composition of the portfolio, is actually digging a layer underneath. And so when we think about being active and our allocations, we can go beyond just the stock bond mix and thinking about what types of bonds do we own, what types of stocks do we own, and what are their attributes. And so within the portfolios, we have been focused on companies with resilient business models that are either less sensitive to the economy. Of course, virtually all businesses are in one way or another sensitive, but those that are less sensitive are those that have their own unique tailwinds where their markets are growing or they have an ability to grow market share overall. And so this leads us to areas like consumer products, areas like gaming, which has been a long-held theme in our portfolios over the past several years, but is an area that we continue to see gain market share in terms of consumer entertainment. Defense contractors are a relatively new addition to the portfolios, but this is one, again, with less cyclical exposure. And unfortunately, as the events in Ukraine remind us, the world is a very unstable, uncertain place. And again, there are drivers for defense spending that are certainly far afield from the overall economy. And then additionally, we do have a small position in our balanced accounts in the gold miners. And gold certainly is known as historically an inflation hedge, although admittedly the performance in this cycle has been a bit more mixed, but also there have been attractive fundamentals within the gold miners in terms of both newfound capital discipline on the company's parts, as well as some relatively attractive dividend yields. Gold infamously does not pay its holders any sort of income, but here we have an opportunity with a modest position in some miners that do actually generate a bit of income for us.
Yeah, I think all of these adjustments that we're making, Chris, that you and your team are making, and all the pieces of our active investment management process are super important to the success that we have over the long term, and the success we have for you all. And this disciplined process that we have is just really impressive. But I want to shift the focus to you as the investors for a moment. And really focus on what are your goals? What are the things that are most important in your life? And those are the things that this is a good time to look at, because the investments are going to help you get there. But we want to know what's important to you so that we can help you articulate that and put it into a financial plan. So if you already have a financial plan, this is a great time to revisit it. And if you have kind of waited to go through that process thinking it may be a bit tedious, I think you might be surprised. Most clients, once they've been through the process, actually get a little excited by seeing all of their goals come into play and seeing that they're going to be able to accomplish all these things that are most meaningful in their lives. It also can bring some comfort during these times when you say, hey, the portfolio's down, and yet I'm still on track to meet all of these goals that are most important in my life. So we have a tool that'll help stress test your portfolio and make sure that you can still accomplish all of those goals. And that's what we're showing here on the screen. And it's just running 1,000 different trials of all the ways that the market could return. So real market type returns, where it's up the next couple of years and then down, or maybe it's like 2008 for the next couple of years, although we don't think those are the same fact set that we have today by any means. But it'll show that up and down of the market and see where you land. So it's just a really comforting thing to go through. So I would highly encourage that, and just making sure that you can get to those most important things, whether that's just your regular lifestyle or gifting to your family, or that trip around the world that you've been wanting to take, or that vacation home that your family can enjoy together. So let's focus on those things that are most important to you and maybe take some of that focus off of the day-to-day fluctuations that are happening. And then it's really about controlling your controllables. So there are some other things that if you really feel like it's important to take some action right now, there are some things that you can do. So for example, if you're about to retire and you're going, oh my gosh, what do I do? Maybe it's looking at, hey, maybe I set aside some extra cash for the next couple of years so I don't have to take out of the portfolio at the worst time. So that spending versus saving lever, we can look at that. Are there some unnecessary expenses that can be cut out right now? Or if you're younger, maybe saving and adding money in, or even if you went to the sidelines a little bit because you got nervous, should you be adding some of that money back? So we can help you make those decisions. Another strategy is tax tax loss harvesting. So we don't always have this opportunity. And this is actually a really good one, because if you do have a loss, we can bank that loss. We can sell out of that investment, bank that loss, which is going to help you with taxes, which is a good thing because nobody likes to pay those. So we can help you with the tax piece and then buy back in and let that growth come out on the other side. And there's also some planning strategies that you can do. So if you've been thinking about a Roth conversion while the values are lower, that's a really good time to consider doing that. We can run those numbers for you and look if that's appropriate for your situation. Or maybe even if you need to get some money out of your estate to the next generation, transferring some of those assets while they're lower valued, so that growth can explode in the next generation's estate rather than yours. So really revisiting that plan, making sure that all the pieces that are going to help your life go the best that they can, that's a good time to do this. So let's take a look at some results, though, because I know that's something that's very important to everyone. And I want to acknowledge that it has been a tough couple of quarters. It really has. And, we're looking at this shorter term view here from 2020 to 2022. And even through that rough time, it's almost like we've been through a full market cycle in 10 quarters rather than 10 years. So it's kind of been an interesting time, right? I'm really proud of the results of what Chris and his team have been able to do. They've softened the blow for us. They have, beat the benchmarks. They have made this, what could have been a much worse situation, not nearly as bad. And I know it doesn't feel as good as the high. Again, we're going to see those fluctuations, and I feel confidence that we'll get back there and see new highs eventually. But when we're going through the worst, we have to remember that patient quote, so that's the importance to focus on. So Chris, we thank you.
No, I think the results here were really built in the months and quarters leading up to the onset of the pandemic, and certainly that was through no view on our part on the actual how COVID was going to unfold, but rather just a response to a market environment that was a very late cycle with then too elevated valuations. And so while the portfolios came into that we'd say underweight or below the midpoint exposure in equities, there was a lot of work that is always going on in terms of idea generation and understanding what do we want to own if we get an opportunity in the market. It just turned out with COVID, with the market falling by a third within a month, we had lots of opportunities really quickly to increase equities meaningfully and take advantage of what was a positive backdrop. So it's sort of the same thing is going on today, even though we look at the portfolios, the market's down 20%, equity allocation still about where it's been for the majority of the year. But there is a lot of work that is going on and active discussions in terms of what do we want to own today in terms of that positioning that I touched on, as well as if we do get to that period of peak pessimism of earnings downgrades left and right, of the credit markets, the spread on high yield debt over treasury debt blowing out to more recessionary levels, what do we want to own? And those discussions are also actively going on today.
Yeah, and I was just reminded the other night, I was watching the movie Braveheart at home, and William Wallace leading the Scottish against the English. And when we talk about this inactivity sometimes that we see in the portfolio, you want to think, hey, let's have action right now. But when the English cavalry was coming in at the Scottish soldiers, and William Wallace and his group of soldiers had built these long spears because they didn't have a cavalry, and they were like, he's sitting there and they're going to have to use those spears at the last minute, and he's saying, hold hold, and right when it's most uncomfortable, that cavalry is right here, the horses and the English soldiers right in the Scottish eyes. He says now, and they take action, and it saves them, and they beat the English in that piece. And so that's kind of what Chris and his team are doing for us, right? They're saying hold, we're watching the data, we're going to do this, and now's time to take action, and that's what's going to lead to our success.
And I do think it's important to just interject. The process that we have is an organic one, right? Where we're not also, that is true. If we get that cataclysmic opportunity, we'll be there. But also we have our deep team of analysts that are looking at the companies in their coverage areas. And if there are opportunities to move sooner rather than later in individual companies, we have the flexibility to do that. So there's no attempt certainly to time the exact bottom, and we wouldn't purport to be able to do that, but rather just as the backdrop becomes more attractive, the natural thing to do is to take more risk, is to invest with that long-term perspective to take advantage of that.
Yeah, absolutely. The disciplined processes are key. It's easy when markets are rising for everyone to say, oh, I bought a certain EV company, or I bought this, and all the returns that my neighbor was able to earn. But it's when markets get volatile that having that disciplined process that helps you stay focused and stick to your plan and push through. I will also add to the numbers that you see here. There are other additional data points on our website that are publicly available if you'd like to see performance cut in a different way. So I know that that's something that I see has come through. That's available. And if you're looking for another specific type of cut at performance, you can certainly reach out to one of our financial consultants, or if you have any additional questions, send us a note and we can get you in touch with whoever you might need to get your question answered. All right. So with that, we are now on to our final section. And again, I know that we've had a decent number of concerned and cautious outlooks and views and perspectives, and sticking to the theme of holding the line or patience, but we do want to also add some rays of sunshine. And so for our first ray of sunshine, on an optimistic transition, Chris, I want to send it over to you to talk about turning lemons into lemonade.
All right. So the objective here was really just to make a couple points. One is that while recessions, periods of falling economic activity are certainly painful, and that's the red numbers that we have here. So going back and looking at recessions that have occurred back to the 40s, and the max drawdown was simply that, the maximum peak to trough loss in the S&P 500 in each of those recessions. And we see a number of 20s and in 30s, and then some in a couple limited cases. But to be sure, those recession environments where economic activity is falling, where earnings are falling, where investor expectations and risk tolerance are falling, which means the valuations or the multiples that folks are willing to put on stocks are falling. Those also start to create their own opportunities longer term. And so as we go through this period of slowing growth, of earnings, declining earnings, declining profitability, all those things, we're effectively reloading or compressing a spring for the next economic expansion. And as that happens, as optimism returns, as earnings grow, as the outlook for the future improves, we see then what happens in the after section, right? The after section is lots and lots of green, and certainly as we move to those longer term windows, say 3 years after the recession, there's a lot of positive growth that happens. And so this is not only I think longer term good news just from a pure market perspective, but then also working with an active manager such as ourselves, we have the ability as we go through those drawdowns to actually shift the portfolios from from fixed income into equities or into areas of the bond market, high yield, for example, that are going to be more procyclically exposed to the recovery. So not only is it the assets that you came into the drawdown with, as our process unfolds, we have the ability then to allocate more assets to those that are likely to recover.
Well said. Susan, I know this next one's near and dear to your heart. Can you talk a little bit about market sell-offs and the opportunities they can create?
Yes, Jerry, thanks. They're going to happen. We know this. And let me just set up this chart for a moment. So this chart, the green bars show the S&P 500 annual total market return, and the blue dots are the largest decline within the S&P 500 for each of those years. And you're going to see every year we have a blue dot, right? So we're going to have those declines. And this is the largest decline. So the market might be off, 17% at one time, and then 25, and then 20. And then 5, whatever the case may be. So this is going to show just that largest decline in the S&P 500. And if you look at this year in 2022, this is only the 8th blue dot that is 20% or more, going back to 1990. So again, I go back to that opportunity. And in 23 out of the 32 years, full annual years shown here, the year ended positive. So not to say that that's what's going to happen right now, but I do think when we look at, and again, back to Chris's last slide, it can be years. We don't have to wait decades. So I think that's definitely a ray of sunshine.
All right. And for our last ray of sunshine, Chris, so far in 2022, we've had a war, we've had the sharpest rate rise in decades, we've got a bear market on our hands, a lot of things to be concerned about. Can you give us a little bit more perspective on these things?
Sure. How about 150 years? What in the 20 plus years I've been in the investment industry, actually all with Manning. Every time something new is unfolded and there's some market volatility, it's, well, this is unprecedented, this is unprecedented, that is unprecedented. But if we step back and take a exceedingly long-term perspective, it does illustrate that there have been major challenges, be they wars, banking crises, sudden market shocks and bubbles, all sorts of things that have unfolded in the American economy over time. And over the long run, the innovation that is able to occur has been a tremendous positive. And you think about, well, what did the S&P 500 look like in 1980 or 1960? I mean, some of the names are still the same, most of them are not, and that's both a function of new opportunities out there that have arose that were never there. And so I think that's just something good to keep in mind. And while certainly this is outside of all of our investment time horizons, we talk long term, this is exceedingly long term. I think that is good to keep in mind that innovation does move on. There are opportunities that are created, and I think it's important to note that we have that flexibility to pursue those opportunities wherever they may be, and not just domestically as we featured here, but also on an international basis.
Yeah, it is remarkable, right? I think back to 2020 and the pandemic and how in the thick of it, maybe we forget in hindsight, but it was scary. Or even the global financial crisis, when the whole financial system and the plumbing really seized up, and we were wondering, what would happen next. But it truly is a resilient system, and it pays to invest for the long term. All right, Chris and Susan, thank you. Before we turn to open Q&A, I do want to make sure that our listeners know that they can reach out if you have any questions, and we're happy to connect you and schedule a call with one of our financial consultants. In addition, we have a number of resources available on our website. I'll call attention to our financial planning blog specifically, which has a range of content from tax to retirement to financial planning insights and some market and economic content as well. So we encourage you all to take a look and subscribe. On that blog, you can also find our mid-year outlook published on behalf of our investment policy group, of which Chris is certainly a key member of. So we encourage you all to take a look, and you can read the outlook on our website, download the PDF, share it with your friends, whoever else you'd like to. So that's available. And then lastly, the Wealth and Tax Planning Guide, which we published just a few months ago for 2022, which is more of a longer term, not necessarily the here and now, but for the year 2022, what do I need to know about tax law, changing rules and regulations? There's some estate planning, charitable giving stuff in there as well, Social Security suggestions, tips, and things to think about throughout this year and then into tax season next year. So we encourage you all to click the link in the chat that we've posted or find it on our website and take a look. And so with that, let's get to live Q&A. And I do want to lead off with a pre-submitted question that we received. Chris, I want to send this one your way. And I know we got a number of them that are along this same line. So I will still read this one directly, though, because I do find the phrasing to be at least a little bit funny. Chris, how will we know when it is time to catch the falling knife?
That is a great question. I think a couple thoughts. One is, if we look back at the history of market downturns and recessions, there's no real time-based rules that we want to apply. It's not wait 30 days or 90 days or 3 lunar cycles, whatever it might be, right? That's not how it works. Instead, what we want to look for is signals from the market to tell us when those opportunities are there. And so in my remarks earlier, one of the things I mentioned was looking to the bond markets, to the corporate credit markets specifically, to give us some guidance in terms of what is the what's the price that investors demand, that extra risk premium to lend to risky businesses. So think of the difference in interest rates between lending to high yield, junk bond rated companies versus U.S. Treasury bonds. And so today that spread, I believe, is about 5% and change, give or take, depending on the individual issuer. But when we get into those periods where you really want to step in and meaningfully increase risk exposure, that spread can get to 8, 9, 10%. So it's wider than it's been, but certainly far from the extremes that would really get us excited. Similarly, looking at signals in terms of market sentiment. So we touched a little bit on earnings expectations, and Jerry, as you so correctly noted, generally those tend to go negative in these markets before we get that ultimate buying opportunity, when we bring every last ounce of optimism out of things. Another thing that we would be looking at is investor flows. Where are people putting their capital or taking their capital from? And so as we perhaps go through the summer and folks are opening investment account statements or their brokerage statements or whatnot, and reacting in sort of that visceral urge to run away, and so the opposite of the discipline and the patience that Susan was talking about, we will look at it. We'll look at flows, and so if we see lots of dollars coming out, generally that's a positive. So we're looking for signs of panic and things like that. And just the other thing I would mention is that process of catching the proverbial falling knife. It is as it implies, it is sharp, and it's not pain-free. And so this is again where I think it's important working with with an investment team that has been through before and that has the courage to step in and know that it's not going to be timed to the day, week, or likely even month, but instead we're going in there as the opportunities become more compelling and have the conviction to ride through any additional pain that may come, and in fact likely deploy more capital if it gets worse. So that's something else to keep in mind, is that while looking back on these is always is generally a positive exercise, going through it in real time can be quite jarring. But I think that's when it's most important to stick with those disciplines.
Yeah, absolutely. They have something documented and a strategy in mind, that the discipline to go then with the art that makes every cycle a little bit unique and a little bit different. Susan, I got a question here, actually a couple of them. Suggestions and strategies for current retirees, and another one here. This was sent in ahead of time. What about retirees today? So can you kind of address that, the here and now a little bit?
Yeah, I will go back a bit to that financial plan. I think this is where it's really helpful because while it doesn't feel great if our portfolio is down, if we know that we're still getting to do all the things that are most important to us and that make our life meaningful, it's going to be okay. And I think the way that we're set up, that with this investment discipline, you're in a seaworthy ship, and it's built to take these rough times and the rough seas. So we're going to help you get through that, but we can show you that in a financial plan. So again, it's not as tedious as you may think, I promise. And, reach out to us. We can help you through that.
All right. And Chris, I got one more here that I want to send back your way. What are the chances of, and how far down the road does your team expect a recession?
So the way that I've been starting to think about it is picture you are on a roller coaster and you're coming up that first hill and you're sitting in one of the back cars of the train, and a couple of them have already crested the hill, but from your perspective things are still going up. There's still some upward momentum, as it were. I feel like that's where we are today. We look at measures like unemployment is still at multi-decade lows. We had that one exhibit where it's sort of that chart go back 50, 60, 70 years in terms of low at the start of a Fed rate hike cycle. We still have a very healthy labor market. On the other hand, we are seeing some other signs that things are starting to weaken. The housing market is certainly struggling to digest both the surge in prices combined with the surge in mortgage rates, which has done some incredible things to affordability, incredibly bad. Unfortunately, when we look at the average mortgage payment based on median home prices and rates is up something like nearly 50%, just based on some very straightforward assumptions. Unfortunately, for in the U.S., the majority of rates are fixed, so not a problem for folks that already have a home. But you're seeing these things, and these are going to start to cool economic activity. It's fewer houses being built, fewer real estate transactions occurring, and then all the associated purchases that come undoubtedly with a new home and moving and all that good stuff. We're also seeing data in the commodities complex, and broadly, not just one piece like energy or metals, but even food and things like that, where there is a pretty pronounced rollover. We also have we've talked about the Fed and their rate hike cycle. If we look around the world, numerous central banks are increasing. So there's a lot of signs that things are beginning to move towards recession. And then, in fact, we have also had our second negative GDP number just came out this morning. And well, we can look at those numbers, and there's some one-offs going on inside of them. So Q1 was due to almost exclusively to trade, and this one was largely due to inventories being drawn down. There's still some things that's telling us, right? If inventories are falling, that means companies aren't, they probably have too much inventory, and that's what we saw announced from a number of your big consumer retailers. So you're drawing those down, so that's less productivity or less production that's occurring. And the other thing we're seeing, while I mentioned labor market's still very, very firm, you're getting these little cracks. So far it's been companies saying, well, we're not going to replace employees that retire or leave, so we'll get a little smaller by attrition. There was a good article in the Wall Street Journal a few weeks back talking about how some of the companies in some of the really, really growthy corners of the tech world were actually outright rescinding new job offers to employees. So all the things that, right, these aren't massive layoffs, but it's that first step, and certainly business sentiment has turned sour. So it's likely unfolding as we speak in real time. And then how far, how long it goes, I think that's, again, gets back to, let's separate the economics from the investments, right? We talk a lot about in research, understanding it's prices and conditions, right? If we get prices that, hey, the market's priced for a recession and all this pessimism out here, we're not waiting for anyone to say recession is over. And generally, if you wait for recession's over, you've left a lot of money on the table. On the other hand, if by some stroke of good fortune, not I don't think not yet experienced, if I can actually stick the landing and things stabilize and improve, well, conditions just got better, and all of a sudden the decline that we've seen in the market is maybe an opportunity to add a little bit. So we don't want to say we're only looking at X or only looking at Y. We want to have that flexibility to react as the facts change, as they say.
And all the more reason why it's so helpful to have a team of bottom up, top down analysts looking at all of these factors to come together to help make those decisions for you on your behalf. Obviously, not easy to do. Chris and Susan, thank you both for being here today. Unfortunately, this is all we have time for. We will follow up. There are a number of questions I still see, asking about investing cash on some of the visuals. Yes, it is, in fact, the log scale chart that we showed going back 150 years and more. So we'll be sure to follow up with some of those after today's event. We also put a survey in the chat. Please feel free to let us know how we did, what you'd like to see more of, what you'd like to see less of. That continues to help steer these events and make them as effective for you as they can be. And lastly, a recording of this event will be sent out shortly after today's webinar, which, again, feel free to share. So Susan and Chris, thank you both for being here today.
Thank you.
Thank you.
And to our listeners, thank you for attending today's webinar.